Plans are on track for Singapore to transition to a new interest rate benchmark, the Singapore Overnight Rate Average, otherwise known as SORA. Now, SORA-based loans will be launched by the end of the year. The changes come as the London Interbank Offered Rate, or LIBOR, is likely to be discontinued after the end of 2021. Brendan Tanoto tells us more.
Loans like home mortgages are often tied to floating rates. These are usually pegged to the Singapore Interbank Offered Rate, or SIBOR, or the Singapore Swap Offer Rate, or SOR. So when these rates rise, homebuyers, for example, will have to cough up more for their mortgages. But the SOR, which uses the US dollar LIBOR in its computation, is in the process of being phased out. It will be replaced with the Singapore Overnight Rate Average, or SORA. The reason is the LIBOR had gained a bad reputation following the global financial crisis. American and British authorities found that traders had manipulated the LIBOR to make a profit, and it will be discontinued after the end of 2021. The steering committee that's overseeing this transition says it will only affect consumers that have, for instance, loans or bonds pegged to the SOR. It's also too early to tell if SORA-based loans will be more expensive to service, because unlike the SOR and SIBOR, which are term rates, SORA is an overnight rate, where day-to-day changes can be volatile. Plus, it isn't directly affected by the US economy.
We need to make sure that we give consumers the alternatives. If the benchmark rate is going to be SORA, if they're not comfortable, we will still have to give them an alternative to go into fixed rate loans as well as the SIBOR loans right now offered in the market. I think generally SORA is not as, I would say they're not as visible, and most of the consumers are very much more familiar and comfortable with SIBOR.
Now, Singapore's central bank has urged financial institutions to be proactive and make necessary preparations for the transition from SOR to SORA. Now, this includes setting up internal governance frameworks as well as ensuring that there are sufficient resources to train staff as well as to educate and engage customers about the transition. Now, this is so that customers will be able to make informed choices which will have an impact on their financing.